Well, I'm sorry, this is going to be the most specialized of the lectures in a way, because it's about the banking system, and it's always it's quite technical. I mean, not technical in the mathematical sense, but quite technical in the terms that are used. Well, what the collapse of 2008 and 2009 showed was that that conventional monetary and fiscal policy wasn't enough. The crisis was caused by the instability of the financial system. So that led to the demand for something called macroprudential policy, designed to prevent the financial system from incurring the risks which systematically threaten its stability, and if it collapses, the stability of the economies which depend on the financial system. So all countries are now engaged in banking reform through a variety of institutional arrangements, and I want to talk a bit about that. Now, first of all, as in previous lectures, I want to say a bit about the pre-crash orthodoxy. And pre-crash orthodoxy assumed that banks were efficient in allocating capital by correct judgment of risks, and therefore that they only needed light touch regulation. Financial innovation, that is the whole securitization of risk, was seen as stabilizing, not destabilizing, but as stabilizing, by creating a complete range of financial institutions for every kind of risk preference. And in other words, generating what was called in the jargon complete markets. Bank lending was not seen as a source of investment instability. DSGE models taught to students paid no particular attention to the banking system. It was just part of the efficient market system. And all that orthodoxy simply was blown up when the banking system collapsed in 2008, 2009, leading, as I said in a previous lecture, to the Queen's question: why did no one tell us that this could happen? Now, what is the technical description of what went wrong? Well, Alan Greenspan had a good phrase for it when he said that banks had been underpricing risk. Underpricing risk. And then the question is, why had they been underpricing risk globally? And one account, which I think is as good as any, attributes this underpricing of risk to accounting rules, particularly mark-to-market or fair value accounting. And that's the first of my little things I want to talk about. This again is quite technical. Can someone explain mark-to-market accounting for me? None, obviously not one of the professors, but someone else. Mark-to-market. Tell me about it. It's key thing to understanding the operations of the current banking system. Well, it's the process by which by which securities are valued at their current market price rather than their actual purchase price. That is the price at which they were bought. So there's a constant revaluation of the assets of banks by their current market price, not their historical price. The actual contrast is with the historical valuation accounting. And by, I mean, in terms of, sorry, I meant to say historical cost, the same thing. Historical cost accounting. I mean, historical cost accounting, you put on your balance sheet what you bought the share at. That is its historical cost, what you paid for the capital. But in mark-to-market accounting, you value your capital at the current value of the shares. It's sometimes called fair value accounting. I'll wait for... Now, obviously, mark-to-market valuation is much more risky than historic cost valuation, because, I mean, the advantage of historic cost accounting is it's straightforward. You paid so much. That appears in a transparent, completely transparent way. And also, you're not going to get, it's not going to get recorded. No profits are recorded until the sale is actually made, so you can actually work out how productive your capital has been. You pay 100,000, you sell it for $1 million, you realize you've made a profit. But you only make the profit when you sell it. You don't estimate the profit before, which is what happens with mark-to-market accounting. And it really, historic cost accounting is simply an expression of the English proverb. I'm sure you have a Russian one that's equivalent to that, which is don't count your chickens before they're hatched. Would you have a Russian? Yeah, count the chickens in the autumn. You count your chickens in the autumn. You don't count them in the spring, you know, and say, I've got so many hens, therefore I'm going to have that amount of chickens. You count your chickens when they're hatched. And that is historic cost accounting. But mark-to-market accounting is exactly the reverse. You count your chickens well before they're hatched, and you say, these are the value, this is the value of our assets, fair value. Now, one commentator, Hyun So-shin, says that mark-to-market accounting encouraged banks to take on more and more leverage and therefore more and more risk as the value of their capital assets rose. This in turn caused the prices of these assets and therefore bankers' bonuses to rise and rise and rise, and eventually to completely unsustainable levels. And in this bubble environment, the collapse in the market value of any important class of assets, such as real estate, threaten both the liquidity and solvency of the banking system. And this is essentially what happened in 2008. Mark-to-market gave the banks a false sense of the value of their assets. And it would have been much better, I think, to have stuck to historical cost accounting. But mark-to-market is the accepted accounting is the accepted accounting and convention for all asset managers and banks. Now, another very important part of the way the banks estimated their risk, the risks they were running, is value at risk accounting. So explain value at risk to me, someone. Mathematicians here. Value at risk. It's all up there. There's a hand going up there. I see it. You should be here. Come on.
I'm fine, thanks.
What?
I'm fine, thanks.
You're fine, but you wanted to say something.
No, you asked if anyone heard about value at risk.
Yeah.
Did I hear you correctly?
Yeah, and you want to say you're going to explain it?
Well, it's a quantile, basically.
Yeah, well, that doesn't get us very far.
Yeah, well, that's like the maximum amount of money you're going to lose, the value of money that is at risk, given certain conditions. You have to assume some distribution.
Yeah. Okay, it's the worst possible risk that they think you can realistically run. And so, you know, it's the question, they thought it was a good question. The banks asked, what realistically is the worst that could happen to our assets in a given time period? If we had some probabilities about possible outcomes, we could put numerical value on realistic. What does realistic mean? And V, at value at risk, defines realistically as an outcome so bad that anything worse is highly unlikely. It only happens when the likelihood is less than some benchmark level. And this is a sort of typical kind of value at risk diagram. And what you're asked to suppose is that the random variable W is the value of a portfolio in 3 months' time. Suppose W has a known probability density, as depicted in the figure above. The base level, W0, is today's value of the portfolio. Outcomes are measured relative to today's value. If you set the confidence level at 99%, then the value at risk relative to today's value is the distance indicated by the double arrow, yes? That red arrow. That is the value at risk. And it's all based on a Gaussian distribution. And so there it is. That's the value at risk relative to the benchmark, which of course expresses a 99% confidence level. Now, the point is that, you know, that confidence, that is rather arbitrary. What about this tail over here? That's the flaw in the whole system, really. I mean, first of all, VAR is not a good measure of potential extreme risk because it disregards outcomes that have a probability less than the benchmark level. And Nassim Taleb has called these tails, I mean, these fat tails, if you like, black swans. Or catastrophic events that have such a low probability that they're not part of the a normal distribution, but they come. And when the banking system collapsed in 2008, 2009, some bankers said, but look, this event, this collapse was only supposed to have happened once every 10 billion years, you know, based on their value at risk models, which is ridiculous. But second, and more fundamentally, it assumes the whole value at risk modeling assumes that we have known probabilities for all risks, when in fact, for all kinds of risks, for many kinds of risk, the probabilities are unknown. We can't either fit them into the fat tails or we can't fit them in anywhere. They're just, we don't know, we don't understand, we cannot model them mathematically. It's not that there was a very, very low risk of the financial system collapsing in 2008, 2009. We didn't really have any scientific basis for calculating what the risk was, but we assumed we knew. And therefore, value at risk creates false confidence. Now, one very important distinction Keynes made, which is why I think he's such a genius, because he cut through all this stuff. And even if it was 70 years ago, he understood it. He said you have to distinguish between risk and uncertainty. Risk is a mathematical expectation based on a known probability, or at least an assumed known probability distribution. Uncertainty applies to a situation in which the probabilities are unknown. Can you imagine a situation in which you don't know what the probabilities are? Well, it happens every day in life, actually, but it's been excluded from mathematical risk models. But we have to act. We're humans. We have to decide what to do now, and we have to make some estimate of the risks we run. And so we bet on the outcome of a decision. We bet that it'll go this way rather than that way, and we justify our bet by investing it with the character of a scientific prediction. In Keynes's view, securities, assets, are priced not by knowledge of probabilities, actual knowledge of probabilities, but by conventions, roughly the view of the market. It pretends to knowledge of probabilities. And Keynes writes, a conventional method of calculating risk ensures considerable continuity and stability so long as we can rely on the maintenance of the convention. But a method of calculation so flimsily based is liable to sudden and violent changes. New fears and hopes will take charge of human conduct without any warning. And so suddenly everyone's been, valuing their assets in the way I've just described, using mark-to-market, value at risk models, and suddenly their assets are worth half of what they were before. And so they're all bankrupt. But they shouldn't have been using a methodology of valuation that depends on precise knowledge of probabilities, because they hadn't got it. And it's no good saying, well, this only happens once every 100 years. You don't know how often it's going to happen. These black swans. Tell me about black swans. Anyone know how the phrase black swans originated? They're lebed is swan, chorny lebed. Black swans, where does it come from?
I find it interesting that many people use this phrase but don't know where it came from.
Yeah. Okay. It was something reported in the 18th century when they first went to Australia. I mean, all swans are thought to be white, yes. But then this explorer found there was some black swans, very few, but they were there. So the proposition all swans are white, which everyone had thought before, was untrue. Not all swans are white. Some swans are black, and there are not that many of them. But when they sort of fly into some area, then suddenly all the variables, I mean the random features of a bell-shaped model sort of disappear. They interfere with every single proposition based on the idea that all swans are white. And that's how black swans originated. I don't know whether any of you have seen any black swans, but if you look it up in Wikipedia, you will see some black swans. They'll have a heading of black swans.
There are black swans in the center of St. Petersburg.
Are they black because they're dirty or because they're
No.
they're genuinely black?
Just very, very close to Russian Museum.
Yeah, that's near Russian Museum. Black swans.
Anyway, black swans is a very important concept in financial discussion right at the moment, and this is where it comes from. So now we come to the reform of the banking system, having this great big collapse. So what are the principles of reform? Banks are to be made more resilient, their performance more carefully monitored, macroprudential regulation. Now here are the four principles of banking reform as they've been discussed in the last 5 or 6 years, and I want to go through them one after another. First of all, protecting the depositors. The depositors obviously take a hit if a bank goes bust. And what really happens then is that the government bails out the depositors. There's usually a deposit insurance scheme of some sort, but they needed more support than that, because if the bank bails out the depositors, if the government bails out the depositors, it's actually the taxpayer that bails out the depositors. So you want to make banks more resilient. You want other ways of protecting depositors. And the currently accepted method or discussed is to separate out some of the functions of banking. In the UK, it's called ring fencing. And that's based on a proposal of a commission by Sir John Vickers in 2010. Following his recommendation, the government decided to implement ring fencing in a special act of Parliament, though it's been postponed till 2019. And other countries have adopted similar proposals. And I quote one writer, he says, everyone wants to ring fence something, but they can't agree on what. So I think that ring fencing is the flavor of the month. Now, under the proposal of Vickers, the investment branch of a bank was to be separated from its retail branch, but not operated as a separate entity. They weren't going to be split into different banks, but the two branches, retail and investment, were to be separated. Retail, they were each to have their own board of directors, but they remained part of the same parent company. And the idea was that banks wouldn't gamble with their depositors' money. Retail banks would do what retail banks had always done, which is to give their depositors loans if they wanted them, maybe to finance a bit of the small businesses, but not to gamble with their depositors' money on speculative investment projects, which had no relation to the wishes of the depositors. And some people have simply said that this ring fencing isn't going to be effective. Paul Volcker, the former Federal Reserve chairman, said, I find it puzzling to suggest that within one organization you can have a branch that is entirely independent of another organization or subsidiary with the confidence that the two shall never meet. In other words, Volcker was saying that even with ring fencing, ways would be found of the investment branch taking money, using depositors' money for its activities. Yeah. Then, of course, there's another objection, which was quite powerful from people who didn't like regulation, really, saying that ring fencing would diminish market disciplines, making implicit bailout promises explicit. Here's one quotation. "The whole point of ring fencing is that the government would bail out the retail arms. But we don't want it more certain that retail arms of banks are bailed out by the government. We want to end bailouts, not to make them more likely. If bailout promises to retail arms of banks are increased, then those banks will have incentives to engage in the riskiest practices the nature of their business allows. And this means loans to dodgy high-risk business, high-interest rate mortgages to homeowners that have defaulted before, high-risk personal loans to people that are already well in the red. When times are good, these loans will pay out, the banks will make high profits, the employees will get high bonuses, the shareholders will get high dividends, and when times are not so good, these borrowers will default, the banks will go bust, and the taxpayer will pay out." In other words, retail banks themselves are at risk. And if they have access to funds in the same organization, even if they're ring-fenced, they will use them to increase their risk. That's the argument against ring fencing, that is separating out different activities within the same organization, the same bank. So basically, if you think you can, that's a problem, the next logical step is to say retail banking and investment banking should be done by separate banks, banks that are not connected to each other. And that means that the taxpayer liability will be confined to a retail banking sector which has not got any investment function in the organization, leaving the investment sector, including private equity and hedge funds, to operate at their own risk without collateral being provided by other depositors, by the depositors. So that's a more radical reform. This was the subject of, and this was the reform that was actually passed in America in 1933 in the wake of the last great banking collapse, and it was known as the...
Two names.
Yeah.
Glass-Steagall.
Glass-Steagall, absolutely. The Glass-Steagall Act of 1933. That did separate out retail from investment banking. But that act was modified, whittled down, and finally repealed by Clinton in 1999, sorry. So you can see that there were these reforms. Then as the financial sector got more and more powerful and sort of its lobbying got stronger, and gradually all these regulations like this were repealed. And total separation is the object of the so-called Volcker Rule, which was passed into law Volcker's basically a good man. He's very old, but he's lived through past depressions, so he sort of understands the fragility of all these systems, and he has no time for all these whiz-kid quants who tell him that they've managed to manage every kind of risk. Anyway, the Volcker Rule was passed into law in America as part of the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 and bans proprietary trading for deposit-taking banks and bank holding companies with deposit-taking subsidiaries or affiliates. In other words, banks that take deposits are not going to be allowed to trade on their own account. According to Volcker, in the run-up to the crisis, proprietary trading was the strategy that inflated the profits of the largest institutions, inflated their balance sheets, and helped create an enormous level of fragility. because what the banks were doing was really acting as investment funds or hedge funds using their depositors' money. And the depositors hadn't given money for that purpose. They just made deposits at the bank, which they thought was safe, and they earned a teeny bit of interest or something. And here were these banks using this as collateral for their. So the Volcker rule aims to cut that link. Well, in fact, all aspects of the Volcker rule, as they passed through Congress, were weakened. Every single provision of the Volcker rule was weakened. And retail banks, for example, would be allowed to invest 3% of their capital in hedge funds and private equity companies. Whereas, in fact, the Volcker rule had banned every kind of proprietary trading. So there was another rule, another suggestion called the Lincoln Rule, put forward by Senator Blanche Lincoln of Arkansas, which would have forced big banks to spin off their derivatives desk in the same way the Volcker rule would have forced them to give up proprietary trading. Banks would have to make a choice, either forego access to the cheap cash of the Federal Reserve or give up gambling with dangerous instruments such as credit default swaps, CDS. So they'd have to go back to trying to make money in an old-fashioned way. Not much profit, but a lot of security. And but of course they'd been used to make huge profits, to gamble, and therefore the Lincoln Rule was defeated. And there have been other suggestions for reform, which have also not found favor of this kind. So now let's go into my second point, to protect the taxpayer. Some of these are half legislated, but most of them have failed. And so this was the idea that investors, rather than the taxpayer, will be held liable if banks fail. The phrase used about this is, again, a technical phrase, which someone will tell me what it means. To establish a resolution regime. What's a resolution regime? Students only. Well,
Stunned silence.
what?
Stunned silence.
Yes, stunned silence. A resolution regime is a way of liquidating bust banks. And in other words, how do you resolve failed banks in an orderly fashion? That is, transfer all or part of a bank's business, its shares or property, its assets and liabilities to a buyer, another buyer. And resolution regimes specifies the methods of doing it. And so the UK has set up a resolution system, and the EU has set up a resolution. What do you do with the bank when it goes bust? I mean, who's liable? And how do you get rid of it? How do you sort of clean up the mess that it's left? And the European resolution mechanism is. It specifies that it must be universally applied across the European Union, because it makes no sense to have a single European mechanism for the supervision of banks, but to leave the resolution of banks to national authorities. And so they argue that a single resolution mechanism would curb uncertainty and prevent bank runs and contagion in other parts of the Eurozone. The European Commission adopted guidelines requiring that resolution costs, the costs of liquidation, must first be borne by a bank's shareholders and creditors. So there's a hierarchy of responsibility, or hierarchy of costs involved in a liquidation. First be borne by a bank's shareholders and creditors. So they must be the first people to pay the costs. This is, of course, not very easy to achieve. So what after the bail-in, suppose the capital of the shareholders isn't enough to pay the bank's debts. Then they decided to set up a single bank resolution fund, which would come into play only to finance the bank resolution process and not to directly absorb any losses or recapitalize the bank. And this fund is to be financed by ex-ante contributions from the banking sector, building a strong shield to protect taxpayers and avoid contagion. Any resolution fund can only be built up gradually, but a single European fund will reach a critical mass much quicker than national resolution funds and therefore protect taxpayers much more effectively. Before the fund is sufficiently capitalized, it could, if necessary, this is the resolution authority, levy additional ad hoc funds from the banking sector or borrow funds on the market. So contributions from banks to the fund are calculated in a way that reflects their risks, the risk they're running. This means that banks which are financed almost exclusively by deposits, such as many local savings or cooperative banks, would have to make very, very low contributions, if any. And so this fund was set up. Banking is part of the banking union. It's got 55 billion euros to be built up over 8 years, blah, 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 a lot of stuff. And finance ministers will set the bank levies to build the fund, and so on. But of course, who do you think would have objected most? It was a very difficult negotiation, and there was a lot of opposition to creating this European resolution fund, the Bank Resolution Fund. Which, remember, it's in two stages. The first tranche of losses should be borne by the shareholders of the bank. Then there would be a resolution fund to which banks would contribute in order to be able to pay off the remaining liabilities as part of a liquidation process, not as part of a recapitalization process. But who do you think objected most to the fund, setting up the fund within the European Union? Germany, of course, Germany objected most because it feared that its taxpayers would end up covering much of the bank resolution costs. So, again, that was whittled down, and we don't know how effective this resolution mechanism is going to be. So then we come to the third reform, which goes under the name of strengthening financial resilience. All central banks now are given the task of strengthening the financial resilience of their member banks, making sure they're more financially robust. And that means that they have to take measures to improve the solvency and liquidity position of their member banks. So a key aim of banking reform has been to ensure adequate capital and liquidity to protect banks against insolvency or a severe decline in market confidence leading to bank runs. Now, I want to, again, is this? Oh yeah, here we are. I want to just draw attention to this because it's not really understood very well, even by some bankers. The difference between solvency and liquidity. Maxime, what would be the Russian words?
Ликвидность.
Liquidnost.
Solvency. Платежеспособность. Платежеспособность. Able to pay.
Able to pay.
Able to pay.
And liquidity. Okay. Now, what's the difference? A nice definition, please. What's solvency? When are you solvent as a business or as an individual?
When I can pay all my debt.
Yeah, you're right, absolutely. But I wanted to, okay, when you can pay your debts, when you have enough capital or assets, more loosely, to be able to pay your debts. Insolvency is an insufficiency of capital. Put very simply, a solvent company is one that owns more than it owes. Yeah? And that's true. That's true of any business. It's also true of yourself. Yourselves. Now, liquidity. Что это? Liquidity. Ликвидность.
Что такое ликвидный банк?
A bank has to have enough liquidity to carry out its operations.
You can pay for debt very fast.
What?
Liquid bank can pay for debt very fast.
You mean it's just a speedier form of insolvency or solvency? They can pay their debts very fast? No, that's not right, I don't think. At least I would say not. No? Okay. It has to have enough cash reserves or ability to borrow enough cash to pay its depositors on demand. It's still cash. It's a matter of having enough cash. When you go to the bank, and ask to draw out your money, it has to have enough reserves in order to be able to pay you. And if in fact there is some suspicion that it can't get enough cash to do that, then you have something called a bank run. Everyone starts queuing up. They believe the banks cannot meet their obligations to their depositors, and that's what happened. I mean, there have been classic bank runs throughout history, and there was a bank run in England, bank run on Northern Rock in 2007, and then I'm sure there have been bank runs, and there must have been bank runs during the ruble crisis. 1997, 1998, queues at banks trying to get their money out.
Most bank.
What?
Most bank.
Most banks.
Most bank.
Yeah, and in fact, I think distrust of banks was very prevalent in Russia because I think one of the habits of people. Someone I knew, his grandmother always kept all her money under her bed, because she distrusted the bank so much. So huge amounts of rubles, not much, but she wasn't very rich. And then there was a fire that destroyed the apartment block, so all these rubles of hers and everyone else in the block, who were all keeping their money under the bed, disappeared in smoke, of course. They lost everything, which means that under the bed is not necessarily the most secure way of keeping your money. But then banks they're meant to be more secure, but of course they can be less secure. Now, since the 1970s, there has been a relentless rundown in both capital and liquidity ratios. For example, in the middle of the 19th century, banks had to hold 60% capital. 60% capital against liabilities. This was then limited to 12%. Then it was abolished. So pre-crash, banks increasingly relied on borrowing to meet claims. One thing one really needs to note here is that the perception of insolvency produced by a decline in the value of the bank's assets or loans could produce a liquidity crisis for banks by drying up their ability to borrow in the interbank market. So you had a credit crunch, which then spreads from the interbank market to the real economy of lending and borrowing. And following the crash, many banks became both illiquid and insolvent at the same time. They were insolvent because their assets had become illiquid. They were illiquid because they couldn't borrow. So, to my mind, insolvency is by far the biggest danger facing banks, not liquidity. If a bank is solvent, it will always be able to borrow, if it's perceived to be insolvent. If it is perceived to be insolvent, it will face a liquidity crisis. So, what are the solutions to this? Raising capital adequacy ratios. The idea behind this is that by making banks hold a certain amount of capital, they would be able to survive if a significant amount of their assets became non-performing, for instance, due to default on their loans. And the main function of capital adequacy is to enable banks to borrow in interbank markets, that is, to avoid a liquidity crisis. Capital can be derived from retained profits or for money raised from investors. Being able to use retained earnings as capital means that every time a bank makes a profit, it can set aside a certain amount of capital, which enables further lending, which increases capital. Under a stable capital ratio, a bank's balance sheet can expand at the same rate as its retained profits. But notice here that you then come up against the defects of mark-to-market accounting and the VAR sort of system of measuring assets and liabilities. Well, does anyone know about Basel, the Basel Accords? There's Basel I, Basel II, Basel III. What do you think the capital adequacy ratio set by Basel I, let's start with, but what do you think it now is? Well, what do they expect banks to keep by way of capital? What percentage of their liabilities? $10%, 50%, 80%? 3%?
I would say with Basel III, perhaps 15.
Yeah, well, it's 8. It's 8%. Of course, a lot of people want it to be more. It depends which jurisdiction. I mean, it's Switzerland is what? 15. Yeah, well, the Basel minimum is 8. And it's got to be a certain kind of capital. It's got to be risk-free capital. Or very, very low risk capital, tier 1 capital, which much of which is government securities. And that's considered to be very, 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 very safe. And then it becomes more and more risky. Well, all these things have been legislated. They haven't yet been implemented, but they are are going to be implemented. Of course, some countries had better capital adequacy ratios even before the crash, but I mean these are the ones that are coming into. And what holding more capital means is that automatically lowers the leverage ratio. The leverage ratio goes up when your capital goes down, and this suggests some weakness in the system, because the United States had minimum leverage ratio, maximum leverage ratios for many years, but that didn't stop the American banking system from collapsing. Then another thing they're doing, which is part of this capital adequacy sort of reform, is stress testing. To enable the central bank regulators to make sure member banks have enough capital of good quality to survive a crisis. If they fail to meet their capital requirements relative to their risk-weighted assets, they will have to raise more capital. They will be required to raise more capital. And Mario Draghi, governor of the ECB, said the ultimate purpose of stress testing is to restore or strengthen the private sector confidence in the soundness of the banks, in the quality of their balance sheets. Now, a lot of people are very skeptical about stress testing because the banks they're much better at arranging their balance sheets in order to show that they're resilient than many of the regulators are in spotting what they're doing. So, but still, it's an acknowledgement of the fact that there were large faults. Now, I mean, one obvious sort of flaw or weakness in capital ratio, imposing higher capital ratios, is that in boom times, higher capital ratios won't stop banks creating more loans, since banks will find it easier to raise more capital out of the loans they've created. In other words, the Basel capital adequacy ratios are pro-cyclical, not anti-cyclical, whereas what you need is anti-cyclical capital ratios. You don't want banks, you want banks to lend more in bad times and less in good times. Because if they lend too much in good times, then they simply fuel the boom and then create a bubble. And then, of course, the bankers objected to it. They said it'll increase the cost of capital, it'll reduce our business, it'll put the City of London in England out of business, and so on and so forth. And as a result of all these objections, the Basel III rules were delayed, and they won't be implemented till 2019. Then regulating liquidity, that's the second branch. So again, in the 19th century, UK banks held 60% of liquid assets as a total of their deposits. That ratio was halved. Then it was abolished in 1981. Now it's going to be restored. You have 10 to 20% liquidity ratios. But I've argued that it's solvency which creates liquidity. Solvent banks find it easy to borrow. Insolvent ones find it impossible to borrow. The issue is solvency. Solvency is about the quality of a bank's assets and accepted methods of valuing them. Now we come to the last point in my talk, which is changing banking culture. The many suggestions under this head are designed to improve the ethics of banking, mainly to protect the consumer against predatory lending, to attack short-termism, and generally improving public trust in the banking system. Protecting the consumer is one strand of all this, which is protecting consumers from unfair practices from banks. And that's a big theme in Britain, that's a big theme in the United States. New lending standards will be employed in the mortgage industry. No more drug addicts buying mansions with credit cards, and no more of these predatory people just sort of forcing loans on, getting people to take out loans because they get a bonus on the amount of loans they sell. And in perhaps the biggest win of all, there will be new rules forcing some varieties of derivatives, the derivatives, those instruments which Warren Buffett called financial weapons of mass destruction, to be traded and cleared on open exchanges rather than over the counter. So trying to bring what's been a completely opaque market into light for the first time. So I think this is one area where there's a lot of action, or rather talk, going on. Then tackling short-termism. In the United States, the Volcker rule states that traders are to be paid on the basis of fees and the bid-ask spread of their transactions, rather than on any profit made for the client based on the appreciation of the value of the instruments. So the Volcker rule attempts really to get improved incentives, and one of its aims is to make sure that remuneration on stock prices, remuneration on price performance doesn't reward people for short-term returns. There's a whole movement to make bonuses dependent on long-term performance rather than on short-term profits. And the whole culture is against that, because the whole accounting system makes it very easy to calculate your bonuses on the basis of mark-to-market and value-at-risk valuations. And so suddenly your profits go up terrifically, and so your bonuses go up. And your profits go up because you don't have to declare a profit before it's realized. You only have to declare fair value, the fair value of your assets, and that immediately activates the bonus. And in the UK, and I wonder whether this is true in other countries, there was always a big spike in flat and house prices at the end of the year when the bankers got their bonuses. Regularly it went up, and that was actually a very good time to sell if you had a property to sell, because you had the spike in price. Now they're trying to stop all that. They've also got schemes to make bankers claw back bonuses, that the bonus could only be claimed after 5 years, and based on the performance of the bank over that whole period, and not year to year. Because what used to happen, and it used to happen in an asset management company I sat on, and I was on the compensation committee, and it was a huge problem. What you got was that you got a good year, and immediately you had the big bonuses being paid, and the next year was a bad year, but the bonuses didn't go down in proportion to their increase in the good year. So there was an asymmetric system of bonuses. And the penalties were less than the rewards. Now, this of course is also being reformed. Ethical banking. There's a nice phrase, ethical banking. We must have ethical banking, everyone says. And there's a think tank called Res Publica published a report called Virtuous Banking, placing ethos and purpose at the heart of finance. So banks must be responsible to their shareholders, to the community. They should understand that they're intermediaries, not gamblers, that they're actually facilitating the welfare of the community, and there are lots of high-minded proposals that have been brought out under this head. They must understand that banking goes beyond self-enrichment. Bankers have a duty to protect their customers. The bank leadership must promote the underlying ethos that banks need to fulfill this social purpose. And so one of the proposals is something called a banker's oath, modeled on the Hippocratic oath of doctors, that should state that bankers have a duty of care towards their customers. And of course critics have dismissed all this as hot air, and I tend to agree with them. But anyway, these are some of the reform proposals. Anyway, I'll sort of come to an end now. I'd like to leave you then with a final thought over the course of the 4 lectures. The principles of macroeconomic policy with which I started have been shaken, but not fundamentally broken by the severity of the crisis. Unconventional monetary policy was the largest experiment in terms of practice, but it was quite conventional in terms of theory because it was based on the quantity theory of money and inherited all the problems of the quantity theory of money. Fiscal policy was briefly used in the emergency, but soon reverted back to the traditional aim of balancing the budget. Much of the reform of the banking system is not accepted, and even those parts that are accepted have not been completed. So we're left with an incomplete and unbalanced recovery in some parts of the world, stagnation in other parts, and tolerable expectation of further crises in store. And I think there's a sense in the West, at least, that we're entering into a new phase of capitalism in which the old incentives to growth, investment, and even consumption are weakening, and that questions of distribution, the quality of life, protection of the environment are coming to the fore. In short, we feel that the capitalism which has brought nations unprecedented prosperity is running out of steam, but we don't know what to replace it with. Thank you.
Thank you very much. So now we have about, say, 15 minutes for questions. You can actually ask in Russian because I think what Robert doing is,
and if I
will translate.
Yeah.
Okay, let me ask you a question. You mentioned ethical banking by the end.
Yeah.
And this is something Robert Schiller was writing extensively about. So I'm just curious if you think it's a sort of a realistic concept, especially from the point of Robert Schiller's, from his viewpoint, he was writing about something, inventing securities to hedge against, I don't know, unemployment risk,
Yeah.
something like that. Do you think something like that's like viable, potentially possible?
I think that, I mean, my criticism of Robert Schiller, and I reviewed that book a couple of years ago, he really believes that the banking system can be made more ethical by increasing the range of financial instruments it offers and channeling some of those financial instruments to helping not the rich, but other people, like hedging against unemployment and so on. But I don't think that's the way forward. I think you need fewer financial innovations, actually. And I had this argument with him at some meeting we were at, and I said, I don't really believe that trying to make more and more complete markets is actually the way forward, because I think they will always cheat. I mean, in academic terms, everything looks fine, but in actual practice, I think bankers, like any self-interested people, and most of us are, will find a way of making money out of anything that becomes a bit more complicated. because they'll understand how it works. Very few other people will, and they will then be cheated. So I said you need less complicated banking. In fact, I announced some proposition which he thought was wildly retrogressive, in which I said the practices of no banking practices should be beyond the capacity of an ordinary person to understand what's happening. And he said this is not right, that in fact it's highly complicated, very technical, and only the experts can read, but if sufficient, provided regulators are sufficiently equipped mentally and properly paid, they will be able to make sure to eliminate the abuses, and the great benefit will be in the allocation of capital. And so in a way he's coming from that side of things. I have great respect for him, and he certainly had some wonderful results with his index, for example. But I think that's the wrong approach. I want banking to be boring. I want banks to be too boring to fail. And as for the other things, if private equity funds and so on, people, rich individuals, yeah, let them do what they want, but they carry the full costs of the failure of their managers, asset managers. No taxpayer liability for them at all. And retail banks I would even get retail banks out of mortgages. Which they were. They were only brought into the mortgage system 30 years ago. Retail banks did not give out mortgages in the 1960s and 1970s. They just made advances to customers, and generally those advances were either in the form of very temporary accommodation or in the form of loans to small and medium-sized businesses. And so I'd have more local banking. I'd have bank managers who knew more about their customers and didn't have to rely on mathematical models to tell them at what risks they were running. I mean, one of the great penalties of reliance on say credit agencies you needed credit agencies because you didn't know what the hell what the financial position of the customers was. You had no way of telling, no local knowledge. This is where Hayek is very important. I mean, Hayek says local knowledge is the key to efficient operations of markets. A lot of local knowledge. If you have a centralized banking system, which all local banks have gone, no high street banks any longer, everything just done through automatic algorithms, then those then are accredited by credit rating agencies who are paid by the banks to do their accreditation. Then of course you have the makings of a very, very unsound and corrupt system, basically. So I don't think Schiller is the way forward. I may be doing him an injustice.
Hayek said that, I mean, I don't know what Hayek wrote kind of in detail, but I think he came to this point because he came essentially from the German background where all the banks, the lends banking, they operate precisely on that premise, so they know pretty well their customer, and so kind of really localized in a way.
Yeah, but we've gone the other way. We have these vast conglomerates, and the banking system is incredibly concentrated. Every bank owns every other bank, and there are just a few big banks. And except in Germany, where Landesbanks are sort of still, and in Spain, they also had cajas. I mean, they had the small banks, but they all went bust as well. I mean, so there's no magic key to any of this. But on the whole, you should have a decentralized banking system. Hayek, by the way, was always against fractional reserve banking. He always thought that the way to really guard bank solvency was to have 100% reserves against loans.